Hey everyone, and welcome back. So, with the first half of the year behind us and the second half starting, I thought it would be a good time to just reflect back on what happened in the past 6 months, like a very brief overview, and then kind of where I stand in terms of my positions and what I expect going forward here. So, without further ado, let's get right into it. Now, just to put this out there and get this out of the way, I was definitely wrong. So at the end of last year, I had said that I expect another major leg down sometime in the first quarter or first half of the year before we see a, rally higher. And obviously that was wrong because ever since the bottom in October, we've done nothing but go higher. So, in fact, we are now at levels that we haven't seen since, well, the first rate hike began. So, this has caught a lot of people off guard. It's caught me off guard. And if you told me that this would have been the case like a year ago, man, I would not have believed you. But here we are. And yeah, I mean, that's all that can really be said about that. In terms of positions, I am no longer in any of my positions. So with my semiconductor shorts, I am out of those. With my energy longs, I am out of those. Now, with the energy plays, I got extremely unlucky. Aside from the government intervention by the Biden administration, they clearly wanted to manipulate natural gas and oil prices down lower. Aside from that, you also had Mother Nature not really helping out. Europe had one of its most mild winters in history, and as a result, they didn't need that much energy. So that really messed my energy trades up. I got out of those. But not only that, that mild winter helped the European economy to rebound, well, at least its markets, because they're still suffering from a lot of inflation over there and a lot of economic slowdown. But that helped them rebound there, which also helped us rebound here. And then I think I mentioned in a previous video that around the time that we had the October bottom, you also had net liquidity come into the markets, and that essentially pretty much correlated well with the gains we are seeing right now. So that helped, and that worked against my shorts as well. Fortunately, I got out of those a couple months ago, but wow, even then, it has been pretty painful. So definitely not a good start to this year, but hopefully the latter half of this year will bear a little more fruit in terms of my theories. But yeah, not a good start to the year. And yeah, that's pretty much it. All that needs to be said about that. I do have a couple short positions in names that are not too well known. I do not want to reveal those though, because again, it's very hard to find a good short out here because everyone's trying to short squeeze just everything. And I just really want to keep low profile on that. So I will just keep it at that. But yeah, especially for bears, you really need to pick your stocks very carefully here. But also, you kind of have to pick your stocks kind of carefully if you're a bull, because just because the markets have gone up does not mean everything's gone up. And let me show you what I mean here. So this chart here, it's very, very important to note because you kind of look at the chart and you think, oh, well, everything must have participated in the rally. Market's strong. Everything's kind of going upwards. Not really. So if you take a look here, this is the big seven or the magnificent seven. And this includes Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, all your tech giants. These guys have gone up over 50% altogether, over 50% year to date. And again, the year's not over, but I mean, that is a massive gain. But if you take those out, okay, and you like look here and here and here, yeah, the rally in the US and across the globe, not very impressive if you take those guys out, which shows you that this market rally has not had broad participation. So actually, if you look at a lot of companies out there, a lot of them are pretty much flat for the year, or they're like negative year to date. And some of them are really negative year to date. In fact, we've had a couple bankruptcies too. Some of the most amount of bankruptcies since the great financial crisis, and they are picking up fast. So there have been a lot of names that have already gone to zero, and that doesn't even just include the, that's aside from the banks from March, with SVB and First Republic, right? So, you've had a lot of stocks that are going to zero, and that's why that this whole market has been quite fascinating because, again, the overall market has gone up, but it's just been carried by a handful of names. Meanwhile, you have other companies that are basically imploding, and that is really starting to pick up here because interest rates have increased. So if you look at it from that perspective, it makes more sense because you can't raise interest rates by that much and expect nothing happening. Clearly, there are negative effects happening in the real economy. And if you just talk to people in your circle or like family members and friends, I'm sure they'll kind of tell you the same things, like things are slowing down or, they've noticed this or that. So there's real effects happening because of these interest rate hikes. And again, it's a lagged effect. So just because you hiked rates doesn't mean you see the effects happening right away. And we're only about over a year since the first rate hike. But compared to the other rate hikes we saw at the end of last year and the beginning of this year, those effects still have yet to come around. So, once that happens, it's going to be way more noticeable. But until then, markets have been performing pretty great. And it's not surprising if you take a look at this chart of Nvidia. My God, this thing has increased almost 200% since the beginning of the year, and it's now $1 trillion company. So it joined that club. And looking at this chart, it's not surprising that some of the biggest names in the markets, if they throw their weight around, I think they're all like the top 10 are worth like what, $14 trillion. If they throw that much weight around, it's not surprising that they can get markets to go up, even if it's just them, right? So they make up such a large part of these markets. It's good for the bulls for now, but it creates a very fragile environment, especially if one of them or a couple of them start to fall. That's where you start running into issues there. So in terms of interest rates, so we're already at about 5.25. The problem is that are we going to continue hiking? Because last month, June, that was the first month in many months that we did not hike interest rates. So that really got people to thinking that, well, that's it. No more rate hikes because they paused. And, that kind of got the rally going a little further there. But I think what a lot of people missed in that is that, they are pretty much still remaining data dependent, and they didn't take that off the table about further interest rate hikes. In fact, in the most recent interview with Powell and some of the other central bank leaders, they all mentioned that there's more rate hikes on the table. With the exception of Ueda from Japan. But Powell basically made it clear that there's probably going to be like 2 more rate hikes heading into the year. And just based on this core PCE, because you have multiple inflation metrics like headline, core CPI, but the core PCE is the Fed's favorite. And we have not gone anywhere since last year. We are basically flat. And this is very concerning because since then, how many rate hikes have we had? And we're still around these levels. That is concerning because that just shows you how sticky inflation is. And that is concerning to the Fed because, again, their target is around 2%. And Powell basically said that he doesn't expect rates to get to around 2% until 2025. Okay? So yeah, it's not really inspiring much confidence. Markets didn't initially like that response either, but then a little afterwards they continued rallying. So I believe that with the most recent reading here, it does show us that most likely the Fed will continue to increase alongside other data that we've gotten because the economy is running too hot still. Even from my own personal experience, you have houses that are selling way too quickly again, very reminiscent of 2021. People are out and about. Consumer spending is still very strong. I believe credit card debt hit $1 trillion for the first time in U.S. history. So people are out there spending, even if it's money that they don't have, and that is causing this, inflation index to remain extremely sticky. And as long as that's the case, it seems more and more likely that these interest rate hikes will continue. And again, this is coming at a time when a lot of people still think that we paused. So should we have that? I think it's going to be a rude awakening for a lot of people. And that leads me to the 10-year yield. So I would say that a big reason, it's not the only reason, but a big reason why this rally has remained intact is because the 10-year yield has essentially done nothing since, well, October of last year. Remember, we had that crazy rise here, and that really threw markets in for a loop. That did not bode well. And at that time, the DXY, the dollar index, was around 115. It's not anywhere near those levels at this point in time. However, it could get there eventually again. But yeah, the 10-year yield just hasn't moved, even though rates are now at like 5.25. And you have your short-term duration bonds above 5, around that 5% level, 5.25. But yeah, your long-term bonds, your 10, your 30, your 20, those are not anywhere near 5%. However, I do anticipate that to change, especially if we get another rate hike. But I do expect that to change because the Treasury, they are now fundraising. I guess we could just use that term. They're fundraising money for their checking account. And the way they're doing that is by issuing treasuries into the market. And people need to buy these treasuries. But again, looking at the percentage, 3.86%, that is a lot more compared to like the near 0% people were getting on this just a couple of years ago. But that is still not enough because, you talk to anybody and they're like, well, why would I put my money in there for like less than 4% yield if I can just get that in a day with Tesla or Nvidia? Like that mentality is still cemented into the public. And that goes with spending as well. This is what happens when you have 0% interest rates and easy money policies for so long. It's infected the minds of everybody. And that habit, that mentality is so hard to break. So even the bond market, with the Fed having raised rates this much, this quick, they still don't believe. And that is really giving the Fed, at least, a persistent headache, I would say. So these will catch up because, again, you're going to need to entice the public with higher yields in order for all that Treasury issuance to be taken up. And then on top of that, you have the Fed, who is getting rid of Treasury securities off its balance sheet via QE month after month. And then foreign buyers, like entities in other countries like Japan, China, they're also shedding Treasury holdings, and then U.S. banks as well. So that is going to create a lot of need for higher yields in order to entice buyers to pick up all that issuance. So I do expect that this will go up a lot higher, especially since the Treasury needs to issue out longer duration debt. So this yield curve should normalize. It looks hideous at this point, but it should normalize. And once that happens, that is when you're going to start seeing more pain in these markets. And it doesn't have to get all the way to that normalized curve of just a normal curve up. Even if you just get closer and closer to that point, you will start seeing the markets pricing that in. Because again, markets are forward looking, or as they say. So you will start seeing that pain being priced into the markets, because I can assure you right now, we are not seeing anywhere near the level of pain that needs to be priced into the markets that is being exhibited in the real economy. People say that they don't see a recession. They say that everything's fine. I don't know if those people get out too much, or if they talk to anybody, in like the lower classes, because they're like in the aristocracy and they just can't see they just can't see anywhere below their feet. but people are out there suffering. No matter how much the elite think they're good, you need the bottom rungs of society in order for a society to function, or else, it's just not going to work out. And those people are suffering. So if those people are suffering, and even people in the middle classes, the middle class is shrinking every single day. You can't have a prosperous society. With that said, I do anticipate, at least in the short term, I mean, it could go either way, right? This market has, legs to run up higher, but then it wouldn't surprise me again if it went lower, because we haven't had a meaningful correction in these markets for like a couple months now. And if you want to continue higher, that would actually be bullish if you had like a normal correction. However, if you continue going higher and then you have a blow off top, well, that just opens up more of a scenario where you could head down much lower. And that's not really what bulls should be wanting here. But then again, everybody just wants to chase at these points. So yeah, it could happen either way. But so yeah, short term, it's a free-for-all. But as we head out further and further towards the end of the year and into next year, I mean, I just don't see how you cannot be bearish. So that is my view at this point on how all this is going. Also pay attention to student loan debt repayments that are beginning. So the interest starts accruing again in September, and then the payments begin in October. Supposedly the Biden administration, they're going to try to delay those payments once again, or whatever they're trying to come up with there. But those will soon start to come into play here in terms of the broader economic picture, and then people will need to start including that in their models as we continue forward, because that is going to be a big hit on earnings. How much it will be is yet to be seen. So that is kind of one of the big unknowns there. But anyways, yeah, that is pretty much it for me. If you guys have any questions or comments, feel free to reach out. Please like, share, and subscribe, and I will see you all in the next one.